Okay, good evening. This is the third session of this course unit on financial statement analysis. Previously, we completed two sessions. One is that introduction part of this course units. Next is how to read financial statement. Previous time we discussed number of financial statement and how to understand different types of financial statements. Right, as I told earlier, then my assignment also based on that financial statements, right? You have to gather some information from the from financial statement, and you have to analyze them by using analytical tools, right? For analyzing them, then you need to know about the tools and techniques of financial statement, or otherwise you can use that term financial statement analytical tools or technique. Right, now today we are going to continue that sessions on tools of financial statement analysis. Right, now this is regarding the financial statement and definitions. Last time we discussed a number of definitions on that financial statement analysis and the uh, idea behind that financial statement analysis. Here, this is objective of financial statement analysis. It is also uh, it was also discussed under the previous session. Right here, if you move to this objectives again, actually there are a number of objectives. First one is to provide adequate information about the sources of finance and obligations of the finance finance here. Second one, to provide reliable information about financial performance and financial soundness of the concern. Third one, to provide sufficient information about the results of the operations of business over a period of time. Next is to provide useful information about the financial conditions of the business and movement of resources in and out of business. Last one is to provide necessary information to enable the users to evaluate the earning performance of resources or meaningful managerial performance in forecasting the earning potential of the business. Right, these are the objectives of the financial statement. Now we can start with that sources of information. Now here financial statement is primarily based on information presented in the firm's financial statement. There are number of sources of financial statement. You can see some website or newspapers or annual report. There are number of leaflet. Then there are number of sources for gathering that type of information. If you move to the annual report or the financial statement, then in the annual report we can see number of qualitative characteristics as well as the financial statements. Last time we discussed what are the important component of that annual report. In addition to the financial statements, you can see director's report, then that means special announcement, notes to the accounts, auditor reports, CSR report, sustainable reporting, good governance reporting. Then there are a number of reports included in that annual reports. If we consider only about the financial statements, now you can see comprehensive income statement, the statement of financial position or the balance sheet. You are using the term balance sheet, equity changes statement, and statement of changes in financial position. Nowadays we are using that cash flow statement. Here you can see the same information again. Now these are the now before analyzing or comparing two or more organizations or within the same organization, we should have some consistent and some qualitative characteristics of our financial statement or our final accounts. Now, as we all know, under the financial accounting or financial reporting, you already discussed this type of qualitative characteristics of accounting information. These are the required characteristics. Now you can see decision makers and their characteristics. Now based on that, they are concerned about the cost benefits and of that information. I think you are aware with that, and materiality. Then again we can analyze them as separate characteristics, and that means understandability, and decision usefulness. Right. Further, we can divide it into relevance and reliability. Reliability should be there. Then, if we are using financial statement, then we should have, as a uh, interested party, we should have clear that means reliability on this information, and also relevance. Then we should have relevance information. Then in one side, then IFRS and accounting concept, or generally accepted accounting principles, they are providing that type of consistency and relevance and reliability of the financial statement. In addition to that, then most of the organization nowadays, they are trying to provide reliability and relevance information for the investors. Then otherwise, it is difficult to increase value of their that means the shares, and also most of the shareholders and other interested parties, creditors, and other financial institution, government organization, authorities, they are expecting relevance and reliability information from the financial statements. Then most of the organization try to provide that type of information, but actually up to now we can see that type of issues also. Then even we have IFRS and government organization, authorities, tax authorities, and other financial statement analysis, that mean reporting standards board, standard setting board. Even we have that type of parties. It is difficult to see that 100% correct financial statement, right? That is the main issues of that financial statement. In some countries, then they are controlling that information and the reliability of that information, and also the relevance of that information. Uh, then, however, I need to say, final objective is to make that comparability and consistency. Otherwise, we cannot compare uh, two or three competitive organization, or that type of organization with the uh, industry norms, or even we cannot compare say the same organization with the previous information, right? Then as much as possible we have to make uh, information with that qualitative characteristics, relevance, reliability, and comparability and consistency. Those are very much important for uh, comparing that data. Then further you can see some information regarding the comparability definitions, completeness, then conservatism. There are a number of qualitative characteristics. I think you already discussed this part under the financial reporting and financial accounting, right? Then I'm not going to discuss them. However, for further reference, I already included that type of things. Now I need to mention about few characteristics. One is called predictive value. The quality of informations that help users to increase the likelihood of correctly forecasting forecasting the outcome of the past or present events. Then we should have some information, and it should have predictive value. Mean then we can use that type of previous details to predict about the current details, to predict about the future conditions. Then relevancy, another one, relevance, the capacity of informations to make a difference in decisions by helping users to form predictions about the outcome of past, present, and future events, or to confirm or correct prior expectation. Then, if you think about the stock market details or stock market prices, right? Then, in some cases, the value of the firms and the value of that mean line items in the financial statement are not interrelated, right? Then here one of the key objectives here, then value of the firms and the uh, line item of the financial statement should be interrelated as per this requirement. Another one, reliability, the quality of informations that assures that information is reasonably free from errors and bias and faithfully represent what it purports to represent. Even we have audited in financial statement. You know that audited financial statement, they are giving opinion based on the sample. No? They are giving opinion based on the sample. They are not going to trust that overall information. They are giving their opinion based on the sample. Therefore, that accuracy and the reliability, yes, will decrease, right? That the main reasons for, one of the main reason for that, uh, that mean comparatively less accuracy. Then there are a number of other understandability and other, it should be a simple one. Then each and every person, not only for the accounting person, then other person also should understand that should be understand that should be understood that financial details given by the financial statement. Then next one, here this is the analytical tool. Now today our main task is to discuss this type of analytical tools. Now first one, you can see there are a number of classification. Not only this horizontal, vertical, ratio analysis, there are a number of classifications. Then if you refer different different types of books or the books with different author, then you can see different classifications. However, we can discuss that type of classification. Finally, we can summarize our data. Now, if you summarize that analytical tool, clearly you can divide it into two. One is horizontal analysis, another one is vertical analysis, another one is ratio analysis. This analysis again link with the comparability, right? We can compare horizontally, vertically. Based on that, then we can divide into number of techniques. Now, if you move to the horizontal one, horizontal mean we can compare with the different types of time period, different time period with that particular information in the financial statement. For that purpose, we can use trend analysis during last 10 years or 15 years or 50 years details. We can compare based on the base year, right? We can assign the base year 1982 or 1990 or 2005. Based on that, we can compare then sales or the profit or any other items, right? Further, we can discuss, right? That is the rough idea behind this. Another one is comparative financial statement. Comparative financial statement, we can provide that financial statement with number of columns for previous years. In some organizations, some banks, if you think about the Sampath Bank and other financial, then commercial bank, and if you get that financial statement, we can see last 10 years information. In some cases, we can see 15 years profit and the important highlights, right? Then earning per share, dividend per share, then price earning ratio during last 10 years, right? Stock market price during last 10 years. Then all we can see that type of comparative financial statement. And if you think about the comparative financial statement, they can see that deviation, whether it is increase or decrease, and what is that percentage of increase in that sales, or the cost of sales, or profit, gross profit, or net profit, or operating profit, right? Assets, all we can see that increase in percentage, that changes in that type of line item. That is the main information given by this comparative financial statement. Another one, vertical analysis. Vertical mean, within vertical analysis mean during the same period. That mean we can uh, that mean same point in time we can compare the that line item based on the base one of the key item. For example, now we can use common size financial statement. Then if you are uh, analyzing that financial statement, you can use that common size financial statement, common size income statement based on the sales value, right? Based on the sales value, we can arrange that percentage. Then if you think about the sales is 100, what is the percentage relevant to the cost of sales? What is the relevant percentage for gross profit? What is the relevant percentage for operating expenses, selling and distribution expenses? Likewise, we can uh, compare based on the vertical value, right? Further, we can discuss one by one. Another one, ratio analysis. Ratio analysis, yes, it is the most popular one. We can see that yes, few example here: profitability ratios, liquidity ratios, financial stability ratios, then market ratios. There are a number of categories under the ratio analysis. We can use that type of ratio analysis for making decisions. Further, we can discuss one by one. Now, if we move to the first part here, horizontal uh, uh, analysis. Under the horizontal analysis, we can see comparative statement and trend analysis. Now, if you move to the first, yes, first of all, we can move to that simple one, comparative financial statement. Then we can move to the trend analysis, right? Now, yes, again, you can see some information relevant to this classification. As I told earlier, there are a number of classifications regarding this financial statement analysis: external analysis, internal analysis. Then I'm not going to discuss that. Now, if you think about the internal party of that organization, in any particular organization, is the management, right? For the management purpose, we can analyze financial statement. In addition to that, we can analyze financial statement uh, as per the requirement of stockholders or the shareholders, uh, creditors, financial institutions, then general public, government organization, authorities, right? Or the laborers of that, or the workers of that organization. For that purpose, they can analyze financial statement. Then then we can segregate that external and internal analysis. Then short-term analysis. Now you can see that another category. It is concerned with the working capital analysis, short-term investment analysis. Then how to manage that short-term investment, short-term assets. Horizontal analysis, another one. Horizontal analysis and vertical analysis we already discussed. Right. Now another classification here, financial statement analysis based on the evaluation of various aspects of a business. Now comparison we can make that comparison based on yes, intra firm comparison and also inter firm comparison. Intra firm mean within the organization. Intra firm mean within the organization. Intra trade. Now you know that intra mean within the organization. We can compare with the previous time period, right? The inter firm mean in between two or more firms, right? We can see some benchmark and other standard level. Then we can compare with that standard levels or the industry norms, and also we can compare with the competitive organizations, right? That is under that intra-firm classification. Here, this is the definitions on that intra-firm definitions. Intra-firms comparison. If you compare the results of the firm's current operations and financial position with its past results, it is referred to as intra-firm comparison. We are comparing the same the information with the previous time period, past results. We are comparing current information with the past information, current results for performance with the previous performance. Here, then usefulness of intra comparison. Here, if you think about that intra comparison, this is the best example for that. That is called trend analysis. Trend analysis. If you have that trend analysis, then you can compare that long-term behavior of that the same organization. Then next one, we can go to that trend analysis separately. We can discuss. That is under that main category of horizontal analysis. Next one, interfirm comparison. Here, interfirm comparison. If you compare the results of the firm's current operations and financial positions with the competitive organization or competing firms' financial performance and the financial conditions, then that is under the interfirm comparison. Interfirm comparisons are comparison of a firm's performance with that of competing firms with the industry as a whole, or with the results in related to industries, and also with the standard norms or the benchmarking. And inter-firm comparisons may cover a single period or several past periods. We can compare several time period and also with the different organization. Main task of the interfirm comparison here, we need to compare company A with the company B, C, D, and the industry norms or the benchmark of that particular industry. That is the main task under the inter-firm comparison. Then again, if you move to the previous classification for horizontal analysis. Now, I think if you go back to that chart here, this is the chart. Now we are in the horizontal analysis. Now we have comparative financial statement and trend analysis. Next we can discuss common size. Under the vertical analysis we can discuss common size financial statement. Then we can move to the ratio analysis. Then after completing these analytical tools, then we can discuss number of cases, right, by using that means reputed organization, then like United Motors, then Toyota Motors, then commercial banks. Then we can collect information from the reputed bank, and we can collect that type of financial statement, and we can analyze them, and we can interpret them, and we can compare with the organizational that means industry norms, right? That is our main task. Before that, we have to understand that type of key component under the financial statement technique. Finally, we can move to that case studies, right? That is the key objective or ultimate objective of this discussion. Next here, this is horizontal analysis. Under the horizontal one, we can we can see this type of 4 analysis. Now if we move to the horizontal one, this is the horizontal analysis. Horizontal analysis technique compare the financial data of 2 or more years. on the basis of rupee or percentage changes. Right? It is very much clear. Now, don't mix that previous discussion. Previously, I got that intra-company, yes, comparison. Here also same, intra-company, right? Between number of years, right? Within the same organization, we can compare number of years. Yeah, you can see again. You can see that yes, horizontal analysis technique compares the uh, financial data of 2 or more years on the basis of their rupee value or percentage change. Rupee increase or decrease are divided by the earliest year data to obtain the percentage changes. If we assume that our previous year sales is 100,000, now this year sales is 120,000, then based on that, then we can uh, take the percentage, right? Then we have divide that changes from the previous year 100. Right. Now we can move to the first part of this one, comparative financial statement. Yes, comparative financial statement. What is the meaning of this? Yes, we can compare same organization with the previous years, right? Then profit, this year profit with the previous 2 years or 3 years or 5 years or previous year profit, right? Then that is the main concept behind this comparative financial statement. Each and every part is of financial statement analysis or the usage using that financial statement. Different types of relevant parties, they are trying to make decisions based on that information. Then they can compare current situation with the previous situations under the comparative analysis. Then most of the financial statement, that mean organization annual report, we can see that type of comparison. Now if we take a few example, most of the, now if I think you aware with that financial statement, last time also we discussed number of financial statement. I uploaded some financial statement. Then if you refer them, you can see this year information with the previous year information, right? This year information with the previous year information. Most probably you can see this year information and previous year information. In some cases, you can see that percentage change too, right? Then if you are comparing them, then it is important to put that change column also, right? Then clearly understand, then users can easily understand that changes, whether it is positive or negative. Now if you take this one, turnover, then here you can see previous year turnover is 11,505. Now this year turnover is 12,499. Then you can see the progress, right? Progress of that sales or the turnover. It has increased by 8.6%. Then if you think about the cost of sales also increased by, yes, by 7.2%. 7.2%. Then critically we can critically evaluate that type of deviations, right? Then what are the reasons for increase in sales? What are the reasons for increase in cost of sales, right? Further, we can uh, investigate about that changes as an analyst. Then we should have that ability to identify the reasons, right? Then gross profit, previous time 5,373, this time 5,925. Now we can see 10% increment. 10% increment. Then what are the reason behind that? Right? Then that is also important to know. Now here main task is to compare the then this year information with the previous year information, and it is better to identify the difference, and and also we need to clearly mention about the deviation, whether it is adverse one or favorable one, right? Then investors or and other users of financial statement, they can make decision based on this information. That is the main uh, objective of this type of comparative financial statement. Then we can understand that not only that then not only the shareholders, then if you think about that, investors, other prospective investors, and especially internal party management also can make decision based on this type of comparative financial statement. Roughly they can get idea about this financial statement if you use that if they use that comparative financial statement. Here again you can see another financial statement. You can see that changes, then different organization, we can see different line items, right? Then we should be able to read that type of financial statements, and we need to understand that differences. Now cost of sales decreased by 1.3%, right? You can see some deviations. Now if we have that negative or the adverse changes, it is very much important to see that, and it is important to analyze that reasons and reason for that type of unfavorable or the adverse changes. Then if you think about the financial service of financial services operating profit, right? You can see 22.7 minus, then change here. Then you can see that type of changes. Not only that, then you can see another minus, so the adverse amount here, that is called finance cost. Finance cost 16.7%, right? Then adjusted profit before the before taxation, however, you can see improvement by 31 or 32%, no? Approximately 32%. Here, this is a simple method for understanding financial statement. Each and every person who are interested in about the financial statement, then they can uh, make decision, and they can easily understand this type of comparative financial statements. Then if you move to another few examples here, you can see 3 years 3 years information, but here you cannot see that changes percentage, right? Here we cannot see that comparison here, but we can compare that values. But if you are analyzing them clearly, then we should provide that percentage too, right? Here we can get some idea about the assets, property, plant and equipment. We can see some that been just decrease that value, no? Decrease from 34 to 34, then it decreased up to 31. Now currently it is 26, right? Likewise we can see some deviation, favorable as well as unfavorable deviation here, but it is not mentioned as a percentage. It is better to mention that percentage for using this type of information for making decisions. Therefore investors and other interested parties, they are expecting this type of details. Here also you cannot see that classification and changes in percentage, right? However, most of the organization, they are providing that comparison and the changes in percentage, right? Now here you cannot see that as you can see different types of organization here. Now this one just Honda Motors, right? Then their financial statement, sales, revenue, and comparison between 2015 and 2014, right? Cost of sales and operating profit, then profit before income taxes, profit after taxes, profit attributable for the shareholders, ordinary shareholders, earning per share, all are given here. Then this type of information is also important for the uh, interested parties. Then next one, profit for the year. You can see profit for the year and other comprehensive income and all other adjustment. You can finally you can see that the comprehensive income of profit for the year, right? Then in addition to that, you can see additional information, number of ordinary shares and other details, right? If you think about the statement of financial position or the balance sheet, again we can see comparison current assets, non-current assets between that periods, right? 2013, 14 and 15, we can compare them. However, again if you provide that percentage, it will uh, increase the comparability of that information. Right now this is regarding here again compared to financial statement. Here you can see clear uh, clearly mentioned about the differences as well as the percentage. Previously at the very first one, at the beginning we discussed then this year information, previous year information and change in percentage. Here you can see this year information, previous year information and changes and also the changes in percentage. Clearly you can understand that percentage in now sales, you can see sales revenue increased by 235,000, it is approximately 12%, right? Then sales return, then you can see some reduction here, 25,000, it is approximately 20%, right? Then net sales increased by 14.2%. Cost of sales again increased by 12.4%. Gross profit increased by 17.1%. Selling and expenses, selling and distribution expenses increased by 41,500. It is approximately 20% or 19.6%. Administrative expenses decreased by 4,500. It is approximately 4.1%. Then total operating expenses increased by 37,000. It is approximately 11.6% or 12%. Likewise, we can get number of information from this type of simple comparative financial statement, right? Then the most of company listed, especially listed company, they are providing this year information of performance, financial performance and financial position with the previous year details and also the changes, whether it is positive or negative, and also they are giving that percentage too, right? Different organization we can see they are trying to provide different types of details. In some organization they are providing highlights. Now if you refer the previous financial statement, I gave you that Toyota company and other uh, BMW and there are a number of companies. If you see that annual report, then they are providing highlights. Last time I told that then CS Sri Lanka, they are selecting best financial reports in different sectors, right? Sector wise and also overall best financial statement. When they are evaluating that financial statement, mainly they are concerned about that. That means business analysis and management information and how they use graph and chart to convince some important information to the stakeholders, right? Then sustainability reporting and then good governance and that mean, the independence of that director board, then they are providing that in real information to the customers or the relevant parties, all are considered. Then not only that, then financial statement, their quality, then how they prepare financial statement, whether they are using IFRS and relevant uh, standards. All are comparing before giving that best performance or the best annual reports out, right? Then then here uh, also then most of the organization, they are trying to provide that informations for stakeholders to compare the uh, financial performance and the financial condition. Right now, this is a good information, that means good financial statement. Then we easily investors and other uh, stakeholders can understand about the organization and changes during the period. Right here, this is also a simple financial statement, comparative financial statement: sales, cost of goods sold, gross margin, operating expenses, income before taxes, then income taxes, and net income. Here you can clearly understand that variables during two periods and the changes also. Changes you can see 12.5%, 27%. Yes, cost of goods sold increased by 27%. Then we have to think about that, right? It is the major issue of that organization. Sometimes there may be some issues regarding their suppliers or the purchasing procedures, right? Tender procedures. Then again, we have to think about that. I think you are very much keen on these matters because you are most of you are in accounting field, accounting and auditing field, right? Then you can clearly understand that. However, finally, you can see that net income increased up by 13.6%. 13.6%. Then we need to understand the reason for increasing that cost of goods sold, right? If we can control that cost of goods sold, further we can increase that profitability, right? Then we can concern about this. As I told earlier, in some organization they are providing number of that mean information for number of years. Number of years. Again, it is also comparative financial statement. Comparative financial statement. Here, unfortunately, you don't have that details. You don't have that. It's not working. Nice. loading. Okay. Okay, now you can see number of years 2015 to yes 2009. There are details, right? Revenue, then cost of sales and operating profit. There are a number of important line items here. Ultimately, you can see that profit attributed to the shareholders. Here, another comparative analysis here. This is the summary of that financial statement, earning per share, another adjustment here. Then you can compare this year information with the previous year, and also changes you can identify through this type of comparative analysis, right? Mainly we are expecting that financial statement, income statement and statement of financial position and cash flow statement for comparing that okay. Now you can see that yes, we completed that first part. Under the horizontal analysis, we discussed comparative financial statement. This is the trend analysis. Now, the second option under the horizontal analysis. That means second method under the horizontal analysis. We can use this trend analysis. Again, we are going to compare the same organization, the information of the same organization with the previous period. Here in this case we are going to identify the base year, base period. Based on the base year, then we are going to convert other values into a index, right? Now here this is the way 1 year 1 year is taken as a base year, right? As the base year, generally the first year taken as the base year, and also it is assigned 100, right? Then based on that 100 we can identify that relevant index. Now this is the relevant formula for getting this value. Trend percentage or trend value you can, or trend index you can take from the present value, that means current value of the particular variable. Then you can divide this by base year value, then and multiply this by 100. Then you can convert into the trend value, trend index, right? For example, if you think about the sales of this year is 120, then previous year is 110. Then you can take 110 as 100. Then you can divide this 120 by that percentage and multiply by 100. Finally you can convert into the trend value. Now here you are given number of examples here. If you move to this one, you are given this type of details. Calculate the trend percentage from the following figures of sales. Now you are given that sales and stocks and profit details. Now here you can see the real value or the numeric detail. Now your task is to convert this into trend value or the index, right? you can identify that base year first. What is the base year? First year of this data set is 2010. 2010 you can take as 100. Then 1881 of sales, then you can take as 100. Then you can divide all the other figures by them, and you can multiply by 100. Then for example 2000, now if you take that example, right, you can use calculator. Then 1880 sorry 2000 2340 for year 2011. Then you can divide this by 1881. Then you can see that answer. You can multiply this by 100, approximately 124. Now you can see that answer here, approximately you can see that's 124 here, 124.4, approximately 124 here. Again, if you go to this one, you can take this value by dividing this 2655 by this base year value 1881 into 100, right? Again, if you use that use your calculator, 2655 divided by 1881 into 100, your answer is 141.14. then 141, approximately 141, right? And if you take last one, yes, our value is 3768. You can divide this by 1881 into 100. Your answer is 200.31, right? Approximately 200, right? Likewise, we can get trend values of sales. Similarly, you can compute trend value of stocks too, right? For example, again, this is equal to 100, and that is the base value. Then you can, if you need to take this value, then you can type 1154 first, then divide by selected base value 709 into 100. Your answer is 162.76. 162.76, approximately 163, right? 162.76, then approximately here 163. Again, same method you can use to calculate that trend value for profits. Here you can see base value 321. Now if you need to take this value, then what is the way? First of all, we have to type that 527, we have to divide this by 321 equal into 100. Our answer is 164.17, 164.17, approximately 164. Last one, if you take this 627, first of all you can type 627, divide this by base year information 321 into 100. Your answer is 195.32, 195.32, approximately 195. Likewise, we can take this trend value. Finally, after getting that trend value, your task is to interpret it. It is yes, it is easy to calculate that index or the trend value, but your another important task is to interpret them. Now if you read that sentences, right? If you take first one for sales, next one for stocks, another one for profit, right? Then we have to take that uh, uh, three three important columns here. Now one by one we can explain. Now first one, if you consider about the sales, right? Sales. Now you can see the sales have continuously increased in all the year up to 2014. That is one comment on that result. Sales increase, yes, continuously, right? It is okay now. 100 to 124, 141, 161, then 200, right? That is correct. It is very much simple one. True in different proportions, right? Proportions, different proportions. We can see it is not a equal proportion. We can see different proportion here. The percentage in 2014 is 200, 200 as compared to 100 in year 2010. The increase in sales is quite satisfactory, right? That is the overall comment, right? But here if you have some particular deviation, now here you can see that 100, 124, then 141, next one 120, we can see some deviation, change in that direction, right? At that time when we are interpreting this one, you have to add that type of important thing here, and also you have to uh, discuss about the reasons for decrease in that type of uh, item, right? Then if you go to the second variable, that is stocks, the figures of stock have also increased over a period of 5 years. Again same as the previous one, you can see continuous increment here. The increase or in stocks is more in 2013 and 14. We can see rapid change between year 2013 and 14 as compared with the earlier years. Then if we move to the third column, here profits. Here profit again, here you can see 100, 136, 143, and again you can see gradual increment here. Profit has substantially increased. The profit has increased in greater proportion than sales, which implies that the company has been able to reduce their cost of goods sold and control the operating expenses. Right now you can see, yes, you can see only these figures, but you can say more on this overall situation, right? As per your accounting knowledge, in accordance with your accounting knowledge, you can say something about here, right? Overall, about the overall picture here, you can see profit. Now as you all know, profit is the results of that the difference between sales and the expenses, no? Then sales, then you can reduce that cost of sales and also other operating expenses, then finally you can take that profit. Then there may be some changes in that particular operating expenses, right? Controlling that expenses, right? Again if you go to the trend analysis, you can see that line items in uh, balance sheet or the statement of financial position. You can see cash, debtors, stocks, other current assets, land and non-current assets also here, land, building and plant, right? uh, then you can see that value for year 2010, 11, 11 to up to 13, 14. Then again we can identify the base year as 2010, 11. Then based on that we can assign values or index, that is called trend values or trend percentages. Here you can see trend percentages of cash. Here 100, 120, 120. Here 80, sorry, 140. That is, these are the trend value, right? Trend value. Right. Now debtors, if you think about debtors, 100, 125, 162 and 200. Right. Further you can go to the stocks and other current assets, non-current assets. You can see land. You can see that yes, consistent on these line items. Building, here you can 1000, 1200, 1500. Then you can see that increments too. Right. Finally you can say something about the total assets. What is the increment of that total assets? Right. Again you can see that interpretations for each column. The assets has exhibited a continuous increase in trend over the period of 3 years, right? Then the current assets increase much faster than non-current assets. Then you can compare this trend value with the non-current assets. Sundry debtors and other current assets and buildings have shown higher growth, right? Further, you can use your knowledge to interpret these results, right? The key factor behind this, it is important to know this formula to calculate that percentage, right? After calculating this, then you can interpret your results, right? Now here again you can see number of details, right? Again for equity shares, general reserves, debtors, bank overdraft, trade payable, creditors, and outstanding liabilities. Again we can do the same thing. I'm not going to discuss again and again same thing, right? Then you can understand easily that analysis. Now you are given that results, right? Then if you refer annual report, most of them are having that percentage analysis too, right? Percentage analysis too. In some cases it is difficult to identify that type of comparative financials. Comparative financials most probably you can see, but here you cannot identify that trend analysis. However, nowadays you are given that information by annual report, right? Here this is regarding that interpretation about these results. Here these results, right? Further you can refer there. I'm not going to discuss in detail, right? Now we completed horizontal analysis, right? Next task is to discuss about the vertical analysis, right? Under the vertical analysis, you have this technique that is called common size financial statement. If you refer again, if you refer annual reports of reputed companies, then most probably you can see common size financial statement. Here, this is a vertical one. Vertical one means we are getting one item again as a basic base value. Previously, we got previous year or the base year information. Then based on that, we change that index. But here, we are getting the information from the same time period as a base value. Sales or the total assets we can take as base value. Based on that, we can arrange all other values as a percentage of that respective variable, right? For example, if you take that income statement, then you can arrange cost of sale as a percentage of sales, gross profit as a percentage of sales, then operating expenses as a percentage of sales, right? That is the main task under the common size financial statement, right? Now you can take that idea. You can read that description. Vertical analysis involves restarting the rupee amount of each items reported on an individual financial statement as a percentage of a specific items on the same statement, referred to as the base amount, right? When the data in a financial statement for several years are presented in the vertical form, some firms may include only the percentage without giving the corresponding rupee figures. Uh, Such statements are called common size financial statement because all items are expressed as a percentage of common base value, right? We can show that detail as a percentage of common value. That's why we use the term common size financial statement. Common value most probably in income statement, net sales or the sales. In statement of financial position, common value is total assets, right? Based on that, we can arrange our percentages. Finally, we can compare this year percentages with the previous year percentages. This year percentages with the previous year percentages, right? Then we can identify the improvement. Now, for example, if you take cost of sales as a percentage of sales, previous year 25%, this year 20%, then we can see considerable or the significant difference. No, what is the reason for reason behind that? Then we can identify the reason for that type of changes, right? Then if you go to the common size financial statement, here this is one of good example. You can see that sales revenue yes, net sales taken as 100 here. Here also same, net sales taken as 100. Then based on that net sales, we can convert all other figures as a percentage of sales, right? For example, net sales 2097, then gross sales 2195. Now you can divide 2195 by 2097 into 100. Then your answer is 104.7. Then another example, gross profit 816 divided by 2097 into 100. Now you can use your calculator. 816 divided by 2097 into 100. Again 816 divided by 2097 into 100. Your answer is 38.91. 38.9. You can see 38.9. Here also same. If you take this year gross profit 6,697 divided by sales is 1,837. 1,837 into 100. 37.94. 37.94, approximately 37.9. Likewise, we can calculate this values. Then after getting that base value and converting into index in the same year, now we can compare this year common size percentage with the previous year common size percentage, right? For example, this year, yes, here current year details on gross profit margin is 38.9, here 37.9, right? We cannot see big difference between these two, but here if you compare another, yes, here also income from operating, again approximately same. Here somewhat, yes, here again income before income tax, yes, again we cannot see significant difference between them. Here also same, net income 12.6, previously 11.4. We can see some improvement, but it is not a big improvement, right? Right now, here if you have a single uh, time period net sales, now you can convert net sale equal to 100, then all other items you can arrange based on this uh, net sales, right? Divide, you can divide all the values, 574 divided by 990 into 100. Here gross profit 416 divided by 990 into 100, then you can take 42%. Then here income from operations, then you can divide 163,500 by 990,000 into 100. You can see that 16.5%. Finally, you can see net income 1,300, 103,140 divided by 990,000 into 100. Now you can see that 10%. In this way, you can take that answers for this common size financial statement, common size income statement. Here again you can see, yes, you can see that comparison after getting that common size financial statement for consecutive 2 years, then you can compare this year with the previous year. Here this year with the previous year. Actually, we cannot identify big difference between them. Very simple. That mean small difference you can see. Or yes, here ultimately 10.4 and 10%. No, we cannot see that big difference. But in some cases, right, as an auditor or the accountant, you can identify some big difference. Now, if it is 57, 58, if this one is 95, sorry, good cost of goods sold. If you think about this value is 50 or the 40, right? Your value is 40. Now this value is 58. Now big difference you can see. After that, after identifying that difference, now after preparing this common size financial statement, automatically compare that difference. Then you can identify the reason for that. There may be some corruptions or the frauds, right? You can identify through this difference, right? Then this common size financial statement, it is a simple one, but you can identify that type of difference. Auditors also can use this type of things. Now you know that financial review, no, financial review under the all the uh, audit process, you can see that type of ratio calculation and comparison and variation. They are comparing the relevant variations. Those are very much important to identify the exceptional cases, right? Exceptional cases, right? Again, yeah. Now if we move to that statement of financial position or the balance sheet. You know, you can see, you can compare difference between two common size value for 2012 and 2011, right? Here again, total assets is here you get your total assets is 483. Then if you need to take cash or relevant this common size value, you can see 82 divided by 482 divided by 483, into 100. Your answer is 6.97, approximately 17. Right? Here also same. You can divide this 30 by this amount, 387 into 100. Your answer is 7.75. 7.75 means approximately 8%. Right? 8%. Account receivables 120. Right? 120 divided by 483 into 100. Your answer is 24.84. 24.84, approximately 25%. Right? Then again, if you go to this 100,000 for account receivables, then 100 divided by 387,000 into 100. Now you can see 25.83. 25.83 mean approximately 26. Likewise, we can calculate this common size value based on total assets. Previously, in the income statement, we got sales as the common value. Here we took assets value, the total assets as the common value. Then based on that, we can compute that percentage. Finally, we can compare. Here you can see big difference between cash. Previous time 8%, now 17%. Right? We can see big improvement of that liquidity, cash. Right? Here this is remain the same account receivables. Here inventory also not much. That means big change here. Here also same, land, equipment, account, yes, accumulated depreciation also same. The only change here, this cash, right? Then based on that we can interpret, right? After getting this one, you have to interpret that results, not only that calculation. You have to identify the big differences and you have to interpret that results. That is the main task under the common size financial statement. Here you can see that calculation as I discussed earlier. Now you can see that calculation process, right? I am not going to mention again, right? Here you can see that common size financial statement for particular organization. Yes, you are given that 2010 and 9 percentage of total based on total assets. You can see this total assets as 100, right? Then others, you can see 3.9, 3.9 this marketable securities. Here also approximately equal. You don't have, yes, here you can see some difference account receivables. Then merchandise inventory, and yes, if you go to the liability and stockholders equity, we can see that same type of percentages, right? Now if we have big difference, then you can identify it, right? Unfortunately, we don't have that big differences between two consecutive period, right? But if you have, then you can identify them and you can try to find out that reasons for that big differences, or sometime it may have some frauds, and then we have to arrange that fraud investigation, so we can take as exceptional cases, right? Then we can pay much attention on that type of things. Here this is regarding that common size financial statement, then how to take that common size for income statement. Right, now you can see these details. You can further refer these documents. Same thing apply, you can apply for cash flow statements too. Right now here, uh, if you take IBM company, their common size financial statement here, cost of revenue, cost of goods sold. Uh, you cannot see big differences between years, right? If it has, you can comment on that results. Here also, you cannot see that big differences between consecutive 2 or 3 years. Right. Now, again, IBM balance sheet here. Balance sheet. If you compare this balance sheet, you can see total cash 10.27, 10 point here 10.27, 10.24, 9.34. We cannot identify the big difference, right? We try to understand that differences, right? Here also same. Total current assets also here we cannot see that big difference, considerable difference here also same. Long term debt, then further we have to pay attention on that differences. Here also same. Common stocks, uh, here return earnings, you can see it is difficult to see that big difference, right? Okay, now you can see that discussions, right? We can explain about the values, right? Another one, Reliance Communication, right? They are common size statement here, common size statement for year 2005 to here 2014 stock turnover, and here excise duty, net sales, uh, stock adjustment, raw material, employee cost. Yes, you can see that type of financial statement and uh, common size statement. Here this is regarding other important information. You can see that important line items. Here also same regarding IBM, right? You can refer them. Then the third one is ratio analysis, right? Now we discuss horizontal analysis as well as vertical analysis. Next one is ratio analysis. Then after a 15 minutes break, we can discuss about the ratio analysis, right? As per your request, I decided to give that. Okay, shall I start? Okay, now we move to the third technique, that is called ratio analysis. I think among these three, this is the most popular one among the uh, analysts, right? Then you can express this relationship between two mathematical relationship between two variables, that is called ratio. Now if you use financial statement, there will line items in the financial statement to get this ratio, so it is called financial ratios, right? You can see that mathematical relationship between two important variables. Here you can see that variables, then intra-company, intercompany, and also industry average. You can, after computing that particular ratio, right, ratio in between two items in the financial statement, then for example, if you take gross profit ratio, gross profit ratio means gross profit over sales, right? Gross profit over sales into 100. Then if you take that ratio value, then you can compare with the previous period. Now here again we have to remember that qualitative characteristics of financial statement. We always prepare that financial statement based on IFRS and other accounting concept, and that means generally accepted accounting principles. And we are using that type of thing. Then we can see that comparability, relevance, reliability, understandability, right? Based on that, we can calculate the ratio based on that results. That means financial statement information. After getting them, we can compare between the period and also between different competing companies or the firms, and also finally we can compare with the industry norms, industry average, right? Then you can see that picture, clear picture here. You can see that intra-company comparison between 2012, 13, 14, 15 likewise. Here intercompany comparison, company XYZ with company A. Here industry average, now we are considering XYZ with company A, B and C and their average here. Average means industry norms, right? Right. Now if we move to that ratio analysis, there are a number of classification, number of categorization, right? We don't have formal categorization method like that means financial accounting. In financial accounting, we have different IFRS and LKS for controlling that type of events and activities, right? But here we don't have any particular method for categorizing this type of ratio analysis. But generally accepted categorization, here you can see that yes, previously we used that ratio, that profit and loss accounting ratio, balance sheet ratio, likewise. Then we can see that type of classification. Nowadays we are using this type of classification: liquidity ratios, or the short-term solvency ratio, profitability ratios, leverage ratio, the solvency ratio, assets management or the activity ratio, so efficiency ratio, we are using the term efficiency ratio, turnover ratio. And another one, this is the most important ratio category for investors, investors ratio or the market ratio. This type of classification we can see in that type of ratio analysis. Then if you move to first part, this is called liquidity ratios or the short-term solvency ratios. Here we are going to identify the that means liquidity base with that commitment, short-term commitment. Right now we have a few formal ratios. In addition to that, we can measure different types of ratio as per that organization, right? Then this is under the management accounting, financial management. Therefore we don't have that type of particular standards to control this. Then as per the management requirement, we can use different type of variable, that means ratios in between two variables. In some cases we can use that means percentage or the ratio in between operating expenses and sales, advertising cost and sales, we can use for our purpose. Then if our management expect that type of ratio, then our task is to provide that detail and we can compare them. They can use that type of ratio for making decision, right? Then current ratio, one of short-term liquidity ratio, short-term solvency ratio is current ratio. Here we are going to measure the relationship between current assets and current liabilities, right? Current assets and current liability. Then we can measure the ability of that particular organizations to meet their short-term commitment, right? Then asset test ratio, here or the quick ratio. Under the quick ratio, we are considering uh, only about the liquidity, the liquidity or the quick assets, right? Quick assets as a percentage of or the as a ratio of commitment, short-term commitment or current liability. Super quick ratio. Under the super quick ratio, here we are considering, we are ignoring that that means less liquid assets from the current assets. All other liquid assets like cash and that means short-term treasury bill, short-term treasury bill, all are under the super quick ratio, right? Then you can see that defensive interval ratio and net working capital also. But uh, uh, we can discuss one by one, right? If we move to first one, yes, liquidity under the liquidity category, first one is current ratio. Current ratio you can calculate current assets over current liability. It is very much easy to calculate, but when we are interpreting them, we have to careful with that results. Now, for example, yes, evaluating a company's liquidity and short-term debt paying ability. Now you can see that the importance of this ratio. We can use these ratios to show the ability of paying short-term debts, right? Now normally this value should be that is the standard or the norms. Normally it should be 2. 2 mean we should have 2 current assets to settle the one current liability. That is the norm. But it is we cannot say exactly we should have 2 for that current ratio. Then it depends on the industry and the nature of their assets base, so current assets and current liabilities. Right. Then next one, quick ratio. Now what is the difference between quick ratio and current ratio? Yes, most probably we are using some word under the current ratio. We use all the current assets. Under the quick ratio or the asset test ratio, we are going to reduce that prepaid expenses and stocks, right? It is not a 100% correct word because in some cases we can see other less liquid assets rather than that stocks, right? In some cases stocks has that higher liquidity than that debtors, right? Then in some cases if you have that type of situation, then your less liquid asset is debtors, right? Then we have to consider that matter. Then here commonly we can say, now if we have less liquid assets, then our task is to reduce that from current assets. Then after reducing them, we can identify the quick assets, right? In some cases some analysts, they are directly taking, yes, difference between current assets and stocks as a quick assets, right? In some it is depend on the situation, right? It is situational decision, right? But most probably we have to reduce that prepaid expenses and stocks from current assets. In some cases, specific there may be some exceptional cases. At that time, we have to decide which is the less liquid assets when comparing with that stocks and debtors, right? Here you can see that after getting these results, yes, you can measure that that mean short-term liquidity and short-term that mean how to face for the short-term liability, then ability to face for short-term liability. quick then how to face for this short-term liability through quick assets or that means liquid assets. Then next one, yes, you can see that interpretation part. Then how to interpret that results. Now after getting that, yes, quick assets is the current assets which can be converted into cash immediately, right? Then you can see that the standard norm as 1 to 1 or 1, right? The ideal ratio is 1 to 1. Again, we cannot say this is the uh, then this is the ratio which organization should maintain. That is depend on the nature of the business, nature of the customers or the debtors and creditors, right? All are very much important to determining. If the you can see that it means that for every rupee of current assets, right? Our standard or the ideal ratio is 1 to 1. Then it means that for every rupee of current liabilities, the company has 1 rupee of quick assets to settle that 1 rupee of current liability, right? Then we don't have any issues regarding that commitment. We can have enough quick assets to settle that current liabilities. That is the idea behind that quick asset to asset test ratio. Next one is yes. This one also important one among that current assets, current ratios, quick ratios, and super quick ratio or cash ratio, right? Then here super quick ratio is the ratio between cash, marketable securities, and current liability. Cash and marketable securities under the super quick assets over current liabilities. Super quick assets represents that cash and marketable securities. That means marketable security means short-term securities. Cash ratio is calculated by dividing the quick assets by current liabilities. Then again you can see that formula. Next one is defensive interval ratio. The ratio examines the firm's liquidity position in terms of its ability to meet projected daily expenditure from operations. Now here you can see again quick assets over projected daily cash requirement. Projected daily cash requirement you can calculate through this formula. You can see annual projected cash operating expenses divided by number of days in years. Right. Further, we can calculate it. Then net working capital ratio. I think it is also very much easy to calculate. Net working capital means current assets minus current liability divided by net assets. Then again we can use this ratio for determining that liquidity, right? Then here under the liquidity category we discuss 5 ratios. Among them most popular one is most popular ratios are current ratio, quick ratio, and super quick ratio. These 3 are very much popular among analysts, right? Then here I am not going to calculate it. Further we can calculate it. Just I mentioned about that ratios and how to compute that ratio, that what is the formula relevant to that ratio, and how to interpret that ratio. Then next category, as per the second category, profitability ratio. Second category is profitability ratio. Actually profitability ratios also we can divide into 2. One is profitability based on sales, profit based on sales. Other one profitability based on investment, right? Investment. Now if we move to the first part, profitability based on that uh, sales, right? Then you can see that definitions regarding that profitability ratio. The purpose of evaluating operating performance of a business is to determine how successfully it has carried out operating activities for enhancing its profitability. For the long-term survival of business, it must maintain its profitability at a satisfactory level. Therefore, operating performance is primarily important to internal management as well as the owners of that particular organization, and also for the creditors, suppliers, and other interested parties. Then potential shareholders are keen on this profitability, right? They are also uh, consider this matter when they are investing in that particular organization, right? Then you can see that classification: sales basis profitability ratio and investment basis profitability ratio. There are a number of sales basis investment ratios. One is gross profit margin, operating profit margin, net profit margin, expenses over operating profit, expenses over sales, right? You can calculate different types of ratios. Then expenses over sales, then operating expenses over sales, then other advertising costs from sales. Likewise, you can calculate number of measurements to measure that profitability. Finally, we can make arrangement to take that profitability, right? Next one, investment basis profitability ratio. Investment basis profitability ratio. These three are very much popular among investors, right? Return on assets, or return on total assets, return on capital employed, and return on equity. Most of the equity shareholders, they are concerned about this ROE, return on equity, right? Then if we move to that sales based profitability ratio, first one, gross profit ratio. It is very simple, and all you aware with this ratio. The key objective of this ratio is to just determine efficiency with which productions or purchase operations are carried on. You can take that gross profit over sales, net sales, into 100. That is the formula for calculating gross profit margin. As you all know, it is very popular and very much easy and understandable ratio. Then average gross margin earned on a sales of 100. Average gross margin earned on a sales of 100 rupees, right? Then you can take, that is the interpretation of that results. If your profit margin, gross profit margin is 25%, that means that you can earn 25 rupees of gross profit out of 100 sales. What portion of sales is left to cover operating expenses and non-operating expenses? That means that is the rest of that amount. Now, after reducing that sales, reducing that gross profit from sales, right? Then you can identify the remaining part, that is for covering operating and non-operating expenses, right? Then if your profit margin is the gross profit margin is 25%, mean you have 25% of sales to cover that expenses, that mean operating and non-operating expenses, right? Then operating profit ratio. Operating profit ratio, again, this ratio measure the relationship between operating profit and the net sales. The main objective is to determine operating efficiency of the management. Operating efficiency of the management. Again, as per the objective, you can clearly understand how far this ratio uh, important to the management of that organization. Right? You can calculate that operating profit ratio, operating profit over net sales into 100. Again, it is also simple calculation, but after getting your results, you can interpret as yes, an average operating margin earned on sale of 100 rupees. What another way you can say, what proportion of sales is left to cover non-operating expenses? Non-operating. Previously operating as well as non-operating. Now here we are getting operating profit ratio. Then if it is 10% or 12%, that means we have 10% to cover that other non operating expenses too. Next one, net profit ratio. Net profit ratio. This ratio measure the relationship between net profit and the net sales. Objective of this measurement is to determine the overall profitability due to various factors such as operational efficiency, trading on equity, right? In here, this is the final results of the organization, right? Net profit as a result of as a percentage of sales. How to interpret that results? An average net margin earned on a sales of 100. That is the net results. What proportion of sales is left to pay dividend and create reserves? Right here up to this point. Now if we calculate net profit, at that time you already reduced that interest, that means finance cost, right? Already deducted that amount, no, in finance cost or interest, right? Now we have to distribute that profit among preference shareholders and ordinary shareholders, and for the reserves. Then next one, operating cost ratio. Then operating cost ratio also we can calculate as a percentage of net sales. Operating cost ratio, if we take operating cost ratio, that means we can compare their profitability. That means by controlling the operating cost we can earn profit, right? Then we can compare between two consecutive period or two competitive organizations. Next one, cost of sales over sales ratio, right? Again we can use this type of ratio to compare, right? Now one of the main task is to control the cost, right? Then how to control cost and how to compare cost with the previous period, and how to compare cost with the competitive organization. In some organization their selling price is less, comparatively less than other organizations, right? The reason behind that, then they have that means consistent suppliers with low price or specific or special discount. Due to that reason they can sell that type of items under that means competitive prices. Then there are a number of operating expenses and sales, right? Then operating profit margin. You can see different types of ratio with respect to that sales. Next we move to that profitability with respect to the investment, right? Now first one, return on assets. Return on assets. Yes, if you are doing, if you are willing to do research, most of the uh, researchers, they are using ROA for measuring the performance of that organization, right? Performance of that organization, financial performance measured by this type of ROA, ROE, or ROCE, or ROTE, return on total assets. ROTA mean return on total assets, same as ROA, right? Meaning of this ratio here, measure the relationship between EBIT and total assets. What is mean? What is the meaning of this? EBIT, earning before interest and tax. Earning before interest and tax. In some books we can say PBIT, profit before interest and tax, same as EBIT, right? Objective of this ratio is to find out how efficiently the total assets have been used by the management. How? Then that is the asset utilization ability of that particular organization or the management. It is measured by this return on assets. Then in one hand, efficiency of that asset utilization, other hand, performance of that organization, right? You can compute that ratio EBIT over total assets into 100. Here you can see that EBIT, net profit before taxes, and yes, you can calculate this EBIT. Now normally you have a financial statement, income statement, right? Then your task is to identify the relevant variable for calculating this return on assets. Now EBIT, how to calculate EBIT? Yes, most probably in your financial statement directly you cannot identify that EBIT. Then what is the way of identify that amount? Then this is the, yes, you can see this green color box, there's a circle, net profit before tax plus interest. Net profit before tax you can directly identify from the financial statement. Then you have to add back that interest or the finance cost. Interest or finance cost. Then you can identify the EBIT, right? Then next one, average total assets. Average total assets. Here EBIT also, yes. Then if you take that average profit, average EBIT, then here also average assets. Average assets mean opening assets plus closing assets divided by 2. In this way, you can compute that return on assets. Here you can see some descriptions regarding that or logic behind this calculation. Then return on assets, again you can see another alternative here to calculate. Here you can see total assets, right? Previously we took that here, right, right here. Right now here we have taken total assets. Previously we got average assets, right? Here but we can take both this return on assets based on total assets or average assets, but when we are calculating them, we have to have some consistency between consecutive years and among the computer organizations. Here you can see these calculations. Next one is return on net assets. Return on net assets or capital employed. Here we are going to measure the relationship between EBIT and net assets or capital employed. Main objective of this ratio is to find out how efficiently the long-term funds supplied by the shareholders and long-term creditors have been utilized or used, right? Then this ratio we can calculate EBIT divided by capital employed. Then this ratio also very much important to determine the asset utilization and fund utilization, right? The next one, ROE. This is for equity shareholders. This is important ratio for equity shareholders. Again, we are going to measure the relationship between net profit after tax and shareholders fund. Here, net profit for the net profit mean net profit for the equity shareholders. Equity shareholders, right? Net profit for the equity shareholders as a percentage of total equity. Then you can see EAT mean earning after tax minus preference dividend. PD mean preference dividend over equity capital. Here you can see that reserves and share capital, equity share capital, the ordinary share capital into 100. Then we can compute ROE, whether we can calculate it. Then return on equity is defined as net profit divided by net income divided by average stockholders equity. Now you can see that again. You can see that classification. You can take equity shareholders or average equity shareholders, right? Average equity shareholders. Then ROE reflects the return to stockholders or shareholders, which is different from the return for the entire company. The ratio indicates the firm's ability of generating profit for rupee of equity shareholders or equity capital. The higher the ratio, the more efficient the company or the management and utilization of shareholders funds. Then they have already utilized their funds for earning higher profit. Then fund utilization, that is the indicator of fund utilization of equity shareholders, right? The third one, leverage or the gearing ratio. Leverage ratio, gearing ratio, capital structure ratio, or long-term solvency ratio. You can use different name. If you refer number of books, you can see different names, right? Here we are going to measure the long-term solvency, long-term balance between capital, that means equity capital and debt capital. Here, this ratio explains how the company capital structure of a firm is made up, or the debt equity mix adapted by the firm. There are a number of key ratios under this category: debt to total asset ratio, or debt to total capital ratio, or debt to equity ratio. Then debt to total asset ratio, then total debt divided by total assets. This is debt to total asset ratio. Now if we take one example here, company A and company A and the industry average. you can see these results. Company A has 0.47 debt to total assets. Debt 47 out of total assets, right? 47 out of 100 of assets. Then industry also same. Industry also same, right? The company A has average debt utilization relative to the industry. Then we can compare between the same organization here, yes, this year, previous year, yes, we can compare their debt to total asset ratio, and also we can compare with the industry norms, industry average. This means, yes, we have utilized 47% of asset, 47% of debt uh, in this type of assets. Then other 53 from equity. Here, debt to total capital ratio, long-term debt over total capital. Long-term debts includes funds bearing fixed interest or fixed dividends. Then financial leverage ratio. Financial leverage ratio. Then this is the total debt capital over total capitalization. Total debt capital over total capitalization. Right. Again, if you compare this year total capitalization ratio with the previous year, here we can compare these two, right? Further, we can see debt to capital total capital ratio. Then if your debt to total capital ratio is 0.5 or greater than that or less than that, we can identify three types of categories. First one, if your ratio, debt to total capital ratio is greater than 0.05, 0.5, greater than 0.5, that is called high geared company. That means there may be financial risk, right? Financial risk with that capital structure. Next one, if it is equal 0.5, that means even geared company. Even geared means we have equal equity capital and debt capital. Under the third category, the debt to total capital ratio is less than 0.5. That means low geared company. We have comparatively low debt than that equity capital, right? However, we should have balance in between debt. Yes, good balance in between debt capital and equity capital. As you all know, we can take tax benefit from that debt capital, that cost of debt capital, right? Cost of debt capital means, yes, we can take that tax benefit from the interest on debt. However, if we have higher or the high geared debt equity ratio, then we have higher financial risk. Then we have to have some balance in between these two. Then next one, this is also a popular one, debt equity ratio. Then long-term debt over shareholders equity. Long-term debt over shareholders equity. Now we can compute this long-term debt by getting that long-term loan, bank loan, and debenture. Then shareholders' equity or equity capital includes that share capital, ordinary share capital, and reserves. Again, here in this case, previously we consider 0.5 as a benchmark value. Now this benchmark value is 1. What is the reason? Now we can see 1 to 1. Then previously under the denominator we had total capital. Now we had equity capital. Then if your answer is 1 or greater than 1, again high gear, equal to 1, even gear, and less than 1, you can see that low gear. Again we need to think with that balance, how to balance that equity capital and debt capital. As much as possible we can take that debt capital to finance that assets, but we have to manage that financial risk. Then again we can see that results, we can compare them. Then another ratio here, proprietary ratio, then stakeholders equity, and as a as a ratio of total tangible assets. Then and in this time we remove that intangible assets. We take normally the tangible assets only. Then next one, interest coverage ratio. Interest coverage ratio, this is also good measurement for that leverage ratio. Here if this ratio is high, then we can see that freedom for settling them, but if it is low, that means we have again financial risk, right? You can see that interest coverage ratio, EBIT divided by interest charges or annual interest. If your answer is comparatively less, then we have some issues regarding that repayment of interest. Indicator firm's ability to cover interest charges, right? It clearly indicates that ability to cover interest charges. This ratio shows how many times the interest charges are covered by EBIT out of which they will be paid, right? Right. Now if your answer may be too low value or too high value, you can see number of times here. If you have too high ratio for this interest coverage, may imply unused debt capacity, too high value. If it is more than 10 or something, then that means we have unused debt capacity. Then we can increase our or capital, or we can finance our assets by debt. There may be a possibility to increase our assets through debt. In contrast, a low ratio is a danger signal that the firm is using excessive debt and does not have the ability to offer assured payment about the interest of creditors, right? Then this ratio is very much important for owners as well as creditors or the long-term creditors or banks of that organization. Here you can see that company average 3.56, company average 3.56 of this year, but industry average is 5.19. comparatively low in the firm. And not only that, now in 2012, their value is just 10.3. It has reduced to 3.56. Then again, we can see that risk, right? Company A has below average interest coverage relative to the industry average. Then there is a risk about the payment of that interest for debt holders or financial institutions. Next one, dividend coverage. Dividend coverage, same ratio here, earning after tax. Here we have to divide this by preferred or the preference in dividends. Preference dividends. Next one, next key category is activity or the efficiency ratios. Then turnover ratios, asset management ratio, asset utilization ratios, activity ratios. There are a number of names for this. Then if you move to the inventory turnover ratio, the relationship between volume of goods sold and inventory may be stated as inventory turnover ratio. Right? Clearly, you can see that ratio: cost of goods sold divided by average inventory. Average inventory means opening inventory plus closing inventory divided by 2. The ratio indicates how fast inventory is sold. A firm with a higher ratio has better liquidity, right? Normally, if we have higher ratio, that means it has higher liquidity. But in some cases, they have a higher ratio due to the liquidity issue again. What is that? They don't have enough funds to uh, buy that inventory, right? Due to that reason also, we can see the higher inventory turnover ratio. If we normally this value should be 6, around 6, right? But again, it is depend on the nature of the business and the availability of debtors and other debt credit facilities and stock facilities, right? Uh, Here you can see that stock resident period also. Here, after getting that inventory turnover, you can convert into the inventory resident periods. Then not only this in dates, you can see sometime you can see 360 days or working days. You can take 240 given date. In addition to that, you can take 52 weeks, 52 weeks or 12 months divided by inventory turnover ratio. Then you can take that inventory resident period. After computing, then this next one is account receivable turnover ratio. Account receivable. Again, we can take that ratio, account receivables over average daily sales, right? Then finally you can compute that number of days sales in receivables. If this number of days is high, then we have some issues regarding that mean collection of cash from the debtors, right? Then we should have trade-off between these two, right? If you increase that account receivable period, we can increase sales, right? In one side, then we can increase sales. Other side, we may have liquidity issues, right? Then we have to have trade-off between these two. Then here, account payable turnover, cost of goods sold over average accounts payable. Again we can compute them. Then next time we can take annual report and extract that value to calculate these ratios, and also we can interpret that results, right? Just today we are discussing how to calculate it and what are the relevant ratios. Next one, cash conversion cycle. Cash conversion cycle, this is very much important for doing research. Some are doing research in the field of working capital management. At that time, you have to take the cash conversion cycle. Cash conversion cycle including inventory turnover period, then debtors collection period, and payable uh, payment period. Then net result of these three is called cash conversion cycle.
Okay.
Then another activity ratio or the efficiency ratio is net assets to net sales to assets. Here, actually, if you take net assets over net sales, net sales over assets, it is also a indicator about the asset utilization. Asset utilization. This ratio is an indication of management ability to efficiently use total assets. Right? Then asset utilization efficiency, you can measure through this ratio. Okay. Next one, ratio of net sales to assets. Here, same as the previous, right? Net sales over total assets. Net sales over the fixed assets. You can take a number of ratios. No need to limit to into this selected ratios, right? It is depend on the management requirement. You can calculate it and you can interpret the results. Final category is investors ratios or the market ratios, right? This is very much popular among the investors. Now investors should make decision about three important decisions. One is buy when stock intrinsic value exceeds its market value. At the very first day we discussed how to make decision based on the intrinsic value and the market value. They have to compare intrinsic value and market value, right? If market value is less than intrinsic value, what is the decision? They can buy. It is better to buy that type of assets or the shares. If market value equals to intrinsic value, at that time it is better to hold that shares with that shareholders. Then if market price or the market value is greater than that intrinsic value, then it is better to sell that type of shares. Then that is the those are the important decision made by the investors, right? Then they should consider about the intrinsic value and market value. There are a number of methods to calculate intrinsic value and market value. Then you have business valuation method, right? Your next component is business valuation, right? In this course unit, we have two parts. One is called, yes, first part is called financial statement analysis. Second part is called business valuation, right? Under the business valuation method, now there are a number of valuation method. I am not going to discuss them, right? We have separate topic under that. Then by using one of few method, we can identify that business value or intrinsic value. Then we can compare with the market value. Then we can make decision based on that, right? Then you can see that approaches, I am not going to discuss them, but I need to discuss this type of ratios. What are the important ratios for uh, uh, make decisions in the stock market or the market? First one is earning per share. Earning per share. If you see that annual report, each and every annual report, we can see that earning per share, right? Earning per share is, yes, how to calculate it? Earning per share means earning per equity shareholders, right? Earning per equity shareholder. Then net profit available for common shareholders or common stockholders or equity shareholders divided by average number of equity shareholders during the year. Then we can identify the earning per share. Then here you can see that calculation. Then if this value is high when compared with the previous year or when compared with the competitors, that means then stockholders or the shareholders can earn more on their investment, right? You can see that calculations here. Here you can see income and income in net income, net profit. Yes, you can see net profit 91. Here preferred dividends 9,000. Then this is called, yes, this is called, what is the definition behind this? Yes, profit for the equity shareholders. Profit for the equity shareholders is 82,000. Then you can divide this by number of equity shares, common shares 50,000. Then earning per share is 1.64. Right. Similarly, you can compute here profit for the equity shareholders 7,500 divided by 50,000. Your answer is 1.35. When compared with the previous year, you can see higher earning per share. Then we can see improvement of that particular ratio. Then we can think with that reserves. Right. You can see additional details. I'm not going to discuss them. Next important one is dividend per share. Dividend per share. The dividend per share can be reported with the earning per share to indicate the relationship between dividends and earnings. Right here, this is depend on the dividend payout ratio. Then out of that earnings, they can pay portion of that or total amount of that, or they can decide, they mean the management or the director board can decide their ratio, whether they are maintaining whether they are reserving 50% for the expansion of the business or another 50% for the shareholders. That means they can distribute as a dividend, right? Then management can discuss it and management can decide it. That is depend on the opportunity for expansion of the business. Then some businesses are, yes, up to the that mean that standards and higher level, they don't have other ability or the possibility to expand their business. At that time, they are trying to increase their dividend portion. In some cases, in some organization, they are at the growing stage, right, in that life cycle. Then they can expand their business. They arrange more than 75,000 or 75% as retention for expansion. Then just they pay only 25% or 10% or something, right? That is depend on the situation, right? Again, you can see then total dividends divided by number of shares. Then you can identify the dividend per share. Actually, uh, investors, equity shareholders, they expect two types of return from their investment. One is called capital gain, another one is called dividend gain, dividend yield, right? This is the dividend yield, another one capital gain, right? By selling that shares greater than the purchasing price. Right. Next one is yes, book value ratio. Then shareholders equity minus preferred rights. You can divide this by outstanding common shares or the equity shares. Here this is called book value. This is also important for uh, uh, doing that type of research, right? When you are doing research, then sometimes you have to calculate that book value per share. This is the most commonly used popular ratio. This is called price earning ratio. Price earning ratio. Most of the stock market investors and analysts, they are using the payback for the year. Payback period. This is not linked with that payback period under the capital budgeting, right? This is called payback. Payback means how many years uh, will take to cover that initial investment. Initial investment mean if I buy this type of share today, then that amount, yes, I have to cover. Within how many years I can cover that amount. That is the idea behind this price earning ratio. You can see that time, right? Price earning ratio is market price per share divided by uh, earning per share. Yes, how many years we have to take to cover that investment through earning per share, right? You can see this example. Your market price per share is 41. Today we have to spend 41 rupees to buy this share. Then annual earnings per share is 1.64. Annual earning is 1.64, right? Then if we divide 41 by 1.64, this means we have to wait 25 years 25 years to cover our investment, right? Is it clear? Annual earnings is 1.64. Today if you are willing to buy this share, we have to pay, that investor should pay 41 rupees or $41, right? Then he can cover 1.64 per year, right? Then he or she has to wait 25 years to cover his today investment, right? Here 20. Then you can see that uh, ratio with the previous year. Now you can see bad conditions when compared with the previous year. In some organization, now if you have two organization A and B, then price earning ratio of organization A is 3, then organization B is 5. Then which is the better one? Yes, if you are an investor, then what is your decision? 5 or A or B? Yes, A or B? B. Yes, how about you? B. B. How about you? Others also say the same thing, right? That is wrong. Why you are waiting 5 years to cover your investment? If you can cover within 3 years, that is better.
Market price is 5 months.
Yes, market price is, yes. If market, yeah, in this case, you can see 55 years. We have to wait 25 years to cover our investment. in these two, now I got that example A and B. Now in this case, our uh, price earning ratio is 3 times. 3 times mean 3 years. Here, this 5 times mean 5 years. We have to wait 3 years to cover this investment. Here, we have to wait 5 years to cover this investment. Then, which is the uh, most suitable one? 3 years one, A, right? Then that's why I told that this ratio is very much popular among the institutional investors and individual investors in the stock market. Right, now we can see that calculation process, price earning ratio, and some other examples also for dividend yield and uh, earning yield, right? I think you have a clear idea about these ratios. Now, today morning we started about the analytical tools, financial statement analytical tools. We discuss horizontal method, vertical method, and ratio level method. Then finally we discuss ratios. Under ratios we categorize into 5, right? Liquidity ratio, then leverage ratio, activity or the efficiency ratio, profitability ratio, and market ratio, right? Just we discuss the method of calculating it, right? We and also we discuss how to define it and how to interpret that results and what are the objectives of each and every ratios, right? Next time we can extract some financial statement and we can compute ratios and interpret that results. Then your task is to identify that, yes, extract that financial statement and try to prepare that type of ratio. Please come with, yes, come with that financial statement and ratios, including all these categories, right? It may be that mean benefit for you, right? Then next time whether we can discuss ratio analysis, right? Under yes, your assignment also we have to do the same type of thing, right? I will explain next time, right? If you have any doubt regarding this discussion, right, then next time we can continue this discussion. Thank you.